Here's a bet. I flip a fair coin. If it lands tails, you lose $100. If it lands heads, you win $150. The odds are squarely in your favor. The math says take it every single time, and yet almost nobody does. That refusal is not stupidity. It is a measurable feature of the human mind. Decades of experiments show that the pain of losing money is roughly twice as powerful as the pleasure of an equal gain. Losing $100 stings about as hard as winning $200 would feel good. Now scale that one quirk up to your entire financial life. The same reflex that makes you decline a good coin flip is quietly steering when you buy stocks, when you sell them, and how long you cling to a position that is bleeding. It nudges millions of people into the exact opposite of what they intend to do. 2 psychologists won a Nobel Prize for mapping this, and one of them was not even an economist. Their work, plus thousands of real brokerage accounts studied afterward, paints an uncomfortable picture. Your own brain is wired in a way that can quietly sabotage your money. So the real question is not whether you have this bias. You do. Everyone does. The question is whether you can see it working in real time, name it, and stop it from costing you. That is exactly what we are going to do in the next few minutes. Chapter 1. Losses loom larger than gains. This is the single idea that everything else in this video is built on, so it is worth slowing down and getting it exactly right. In 1979, 2 researchers named Daniel Kahneman and Amos Tversky published a paper that quietly rewired how economists think about risk. Buried in the dense math was a deceptively simple phrase that has echoed through finance ever since. Losses, they wrote, loom larger than gains. They did not just assert it, they measured it. Across many experiments, the ratio of pain to pleasure clustered around 2 to 1. Later estimates landed somewhere between 1.5 and 2.5, with 2 as the textbook number. In other words, a loss feels about twice as bad as the matching gain feels good. Think about how strange that is. A perfectly rational machine would treat $1 gained and $1 lost as exact mirror images, equal and opposite. But humans are not that machine. We feel the downside far more sharply than the upside, and that lopsided wiring shapes nearly every money decision we make. This is not a flaw in a few anxious people. It shows up in students, in professional traders, in monkeys trading tokens for food. It is closer to a law of human nature than a personal weakness. And because it is so universal, it is also incredibly easy to overlook in yourself. Picture 2 parallel days. On the first, you unexpectedly find $100 in an old coat. Nice, a small lift to your mood. On the second, you lose $100 from your wallet. That second day eats at you, replays in your head, ruins dinner. Same amount of money, wildly different emotional weight. Chapter 2, Prospect Theory, the map of a biased mind. If loss aversion is the headline, Prospect Theory is the full blueprint of how we actually weigh risk. Before Kahneman and Tversky, economics mostly assumed people were rational calculators who coolly maximized their expected wealth. Prospect Theory replaced that fantasy with how people genuinely behave. Its central insight is that we do not judge outcomes by our total wealth. We judge them as gains or losses from wherever we happen to be standing right now. That reference point changes everything. The same $100,000 account feels triumphant if you started at $50,000 and crushing if you started at $200,000. The number on the screen is identical. The feeling and the decision that follows depends entirely on which direction you came from. Prospect Theory bundles a few powerful quirks together. We feel losses more than gains, that is loss aversion. We get less excited by each extra dollar, so a jump from 0 to 1,000 thrills us more than 1,000 more on top of 1,000,000. And when we are already deep in the red, we suddenly crave risk, gambling to get back to even. That last piece is the dangerous one for investors. When you're sitting on a painful loss, the rational move and the emotional move split apart. Logic says cut it and move on. But loss aversion makes selling feel like admitting defeat, so instead you hold and you start hoping for a long shot just to break even. This was not a small academic footnote. In 2002, Daniel Kahneman won the Nobel Prize in economics, largely for this work, even though he was a psychologist by training. His longtime partner Amos Tversky had died in 1996 and could not share it. Their ideas reshaped a whole field. Chapter 3. The disposition effect. This is where the psychology stops being a lab curiosity and starts showing up in real money, in real accounts, doing real damage. The disposition effect has a beautifully simple definition. Investors tend to sell their winners too early and hold their losers far too long. Selling a winner locks in a gain and feels great. Selling a loser locks in a loss and feels like a wound, so we put it off, sometimes for years. A finance professor named Terrance Odean decided to actually measure this. In a 1998 study, he pored over the trading records of 10,000 accounts at a major discount brokerage, covering 1987 through 1993, tens of thousands of real trades by real people with real money on the line. The pattern was stark. Investors cashed out their winning stocks at a much higher rate than their losing ones. In Odean's data, the proportion of winning positions that got sold was around 15%, while the proportion of losing positions sold was under 10%. The gains got the exit door. The losses got a hug. Put another way, a stock that was up in value was roughly 50% more likely to be sold than one that was down. That is the disposition effect quantified, not as a hunch, but as a number, drawn from thousands of ordinary investors behaving in almost perfect unison. And here's the cruel twist. Odean checked what happened next. On average, the winning stocks that people sold went on to outperform the losing stocks they stubbornly kept. So the typical investor was systematically selling the wrong things and keeping the wrong things. The bias did not just feel bad, it cost real return. Chapter 4. Buying high and selling low. We all know the rule is the opposite, so why does the crowd keep doing precisely the wrong thing over and over? Loss aversion does not act alone. It teams up with two other reflexes. Recency, our habit of assuming that whatever just happened will keep happening, and herding, our deep instinct to do what everyone around us is doing. Together these three turn good intentions into bad timing. Watch the cycle. Prices climb and the headlines turn euphoric, so recency and herding pull you in near the top. Then the market drops, your position turns red, and loss aversion freezes you. Finally, the pain becomes unbearable at the bottom and you capitulate and sell. You bought high and sold low without ever deciding to. Barber and Terrance Odean measured the wreckage. They tracked 66,000 households at a discount broker from 1991 to 1996. The households that traded the most active, most confident investors, earned about 11.4% a year while the market returned roughly 17.9%. That gap is brutal. 6.5 percentage points a year, surrendered not to fees or bad luck, but largely to behavior. Over a couple of decades, that difference compounds into a fundamentally different retirement. The most active, most certain investors did not beat the market. They handed a chunk of it back. The same researchers found the average household turned over about 3/4 of its portfolio every year, churning constantly. All that motion felt like control and diligence, but much of it was loss aversion and overconfidence in disguise, quietly draining returns one well-intentioned trade at a time. Chapter 5. Rewiring the reflex. You cannot delete a bias that took millions of years to evolve, but you can build systems that stop it from making your decisions for you. The first and most powerful move is simply naming the bias as it happens. When you feel a desperate urge to dump a winner just to bank the good feeling, or a clenched refusal to sell a loser, that emotional spike is the signal. Awareness alone will not erase it, but it cracks the autopilot just enough to think. Then build guardrails that decide for you in advance. While you're calm, write rules before you are emotional, automate your investing so contributions happen no matter how you feel, and evaluate any holding by asking a clean question. Would you buy this today at this price knowing nothing about what you paid? That last question is quietly radical. Your purchase price is a fact about your past, not about the company's future, yet loss aversion treats it as sacred. Once you stop anchoring on what you paid and judge each holding purely on what it is worth now, the disposition effect loses most of its grip on you. It also helps to look at your account less, not more. Because losses sting about twice as hard as gains, checking constantly means absorbing far more emotional pain than pleasure, even in a portfolio that is steadily climbing. Frequent checking does not make you informed, it mostly makes you anxious and twitchy. None of this is about becoming an emotionless robot. It's about recognizing that the part of your brain that handles fear was built for fleeing predators, not for holding index funds through a downturn. You design simple rules precisely so that, in the moments that count, you do not have to win an argument with your own instincts. So step back and see the full shape of it. A single asymmetry, losses hurting about twice as much as gains, ripples outward into prospect theory, into the disposition effect, into a whole population of investors who sell winners, hold losers, and quietly buy high and sell low. It is not a character flaw. It is the default human firmware. But firmware can be worked around. The investors who do best are rarely the smartest or the busiest. They are the ones who built calm systems and then let those systems carry them through the moments their instincts would have wrecked. If this reframed how you see your own money, follow Market Minute and tell me in the comments which of these biases you have caught yourself doing.